with inflation being sticky, I think that the rate hikes that the Feds have instituted for the past, 14 months or so aren't really being reflected yet in what, people are feeling. I think that things are going to get much worse when we get to the summertime, when we start looking at small businesses and renegotiating their loans, et cetera. I think that the market's going to have, some challenges ahead, even though these numbers are coming down with the CPI. I think that there's going to have to be some more pain in the economy before we feel, that things are under control and we can have a robust recovery.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we got a CPI number out today that has led to markets going higher, but also gold and silver taking off a bit. Bitcoin kind of shrugging it all off. What does it mean? Well, we have got for you a 35-year veteran of the financial wars here. It's been advising, helping you retire for quite some time. And his name is David M. Wright. David, it's great to have you on the show. And so we got a CPI number out, 0.2%. So is that worthy of celebration?
Actually, Kerry, thank you for having me on the show. It's a pleasure to be here with you. Actually, the CPI number came out today at 3%. That was the headline CPI number. The core CPI, which is excluding food and energy, was still at a sticky kind of a 4.8%. The Fed mandate, they want to get core PCI and CPI actually down to about 2%. So we're a little bit away from that. Right now we're at 4.8% on that core CPI number. But frankly, I think Feds are waiting for the end of the month when the personal consumption expenditure, the PCE index comes out. That's a little bit better reading, Kerry. That's what they look at a little more carefully to see what those numbers are going to show. So I'm going to be one of those people that's a little more cautious and bearish than maybe some of your other guests.
Right. So 0.2% month over month, but an annualized rate of 3% as long as you don't eat and as long as you don't put gas in your car, right?
Absolutely. I tell you what, living on the boots down here in Ohio, we certainly see a lot of people walking out of the stores with a lot less groceries under their arms just because of that. And what I'm seeing here is that with inflation being sticky, I think that the rate hikes that the Feds have instituted for the past, 14 months or so aren't really being reflected yet in what, people are feeling. I think that things are going to get much worse when we get to the summertime, when we start looking at small businesses and renegotiating their loans, et cetera. I think that the market's going to have, some challenges ahead, even though these numbers are coming down with the CPI. I think that there's going to have to be some more pain in the economy before we feel, that things are under control and we can have a robust recovery, more so than just fueled by AI, which is kind of leading the charge right now with a lot of different stocks in the S&P and the NASDAQ.
Well, it's probably AI stocks that are being recommended by AI. There's probably no human intervention in it at all, right?
I love it. Absolutely. Absolutely. And why not? It's in about every sector, about every area of the economy you can find it. So why wouldn't it recommend itself? Heck, with AI, you and I won't even need to be here in probably 12 to 24 months, right?
Right. Well, it'll just buy itself too. It'll put out the recommendation and then it'll just trade it. And talk about trading your own book here, huh?
Yeah, no kidding. I mean, that's a concern all of us have. Where does this lead to it certainly can be used for good. It's certainly an intuitive thing, but at what point does it create more harm than good? It's been estimated that AI could end up replacing far more jobs than robotics could have ever replaced back when the auto industry instituted all that stuff.
Well, I can think of 535 jobs that I would like to see it replace, because it sure can't do any worse than the people we send up to the Capitol, can it?
Amen. I tell you what, this spend has got to end. An AI government. What a wonderful thought that would be. Let's work our way through that one. If would we have an election?
Yeah. If AI was running things, we probably wouldn't be spending all this money in the first place. There'd be a lot more people alive, and taxes would be a fraction of what they are now. Who knows? Maybe AI would have gotten rid of the Federal Reserve too while they were at it.
Could be. You never know.
But in the meantime, we've got a PPI number coming up too. What's the whisper number there?
The whisper number is that it's going to be a little bit under the estimate. That the producer price index is probably going to be running a little bit lower than it was the previous month. Things are, prices are coming down. Shelter obviously is a major component of the producer price index and of the CPI, and those numbers are coming down. But I know that in our area, a lot of people are just kind of staying put in their homes. There's not a lot of new house activity, other than these young bucks that are building these houses at 6% and 7% mortgage rates, or if you got somebody older that's trading their home in for an all-cash deal on something else. But the PPI, probably a whisper number is it's going to be a little bit lower estimate than what they expected.
Okay, so there's two indexes that I pay attention to when it comes to what stuff really costs. Two numbers. Number one is the cost of a Thanksgiving dinner, because that's always the same year in, year out. The cranberry sauce goes up, the mushrooms or the stuffing goes down, but it's always the same basket. There's no hedonic adjustment. There's no nothing. And then 4th of July barbecue, which this year said the bill was down 3% from 2022, but it's still 14% higher than prices 2 years ago. I don't know where they had this barbecue at. They must have been giving away free hamburgers wherever it was, because mine went up.
Absolutely. Same here. Maybe they went to the Nathan's hot dog competition and got some free ones there. Who knows?
Oh, I don't want to think about that. That's a bad visual. But seriously.
Yeah, that's true.
These numbers are just off the wall that seem to have no relationship to reality.
They just don't. Kerry, you look at what our country produces in gross domestic product, actually at 1.3% finalized number for the first quarter, but you compare that to our national deficit, which is currently at nearly $32 trillion. We're out of whack, in that front. You can't possibly measure what the effect of a 0 to 500 basis point hike means to the rest of this year. I've seen estimates that AI could take us up another 40 or 50% before the end of the year, or could reduce us down negative 10 or 20% before the end of the year. There's just too much of a disparity here. I think that the feds could very possibly hike again at the end of this month. If they do, they may hike again in September. Those things are going to create more pain. I think that the whole mandate was that they were supposed to get unemployment, I thought, up to about 5%. But unemployment in our country is still at around 3.6, right? 3.6, 3.7%. So to me, I don't see that the feds have created enough demand destruction yet, although inflation is coming somewhat lower. It seems to me that we're going to, there's some work to do yet.
So what's an investor supposed to do when you got this silent, stealthy tax that effectively devalues the value of your investments by killing your purchasing power. What are you telling your people after all your experience? I think what's good is you and I both remember the inflationary 60s and 70s and early 80s. You and I both know these things go in cycles. They don't just go away because the Fed decided to raise rates one day and they happen to follow through on their threat, right? These things can go on for a decade or more.
They really can. Kerry, I think that the reality of the situation is people have to come back to basics and understand what their money is for. If I'm working with someone, I just this morning had somebody come in who has a couple of $1 million. Part of the money they want to buy a lake home with it. So if that's the case, then we ride the wave of AI. We ride the wave of growth stocks. We watch it diligently and make sure that we don't get caught in a whipsaw effect. But by and large, the majority of my clientele, they rely on their 401ks, their IRA accounts for income. So I know that a lot of growth advisors promote growth as an inflation hedge, right? But to me, getting caught in a downdraft unexpectedly is the worst inflation hedge that you could have. So the reality of the situation that I see is creating income streams from the investments that you have, having both, high dividend paying stocks that create some growth in years where growth can be made. And at the same time, finding those companies that can, be sustained beyond that with income dividends of, 5 to 7%, knowing what your money's for and making sure that your pensions and Social Security have that additional amount of cash flow that's reliable and repeatable from your investments is, I think, the way to go for the future.
Okay. So can you give us some examples, not necessarily recommendations, because everybody's situation's different, but what are some good dividend payers out there now?
Well, we've got quite a few. I'm not going to get into any names and stock picking here. They can go to wrightfinancialgroup.com and get some of those names and recommendations. But, by and large, most of the AI stocks that are out there aren't paying much in the way of dividends. And we certainly want to stick with those companies that are, consumer staples. We know that so far this year, consumer discretionary is still leading the way. But to me, that's going to be short-lived. I know there's a lot of people at the airport still, a lot of people that are going on cruises and staying in hotels. But I think at some point, we look at the debt, consumer debt, what's going on there. People are going to realize that they got to slow down the spending. So those companies that favor, repeat, steady staples.
Yeah, so you got your P&G type,
right.
You got to have your razor blades. Women got to have their cosmetics, no matter what the economy's doing. They're going to be buying them, right?
Yeah, there you go. Exactly.
Defensive names, basically.
Absolutely.
I know.
Absolutely.
So the defensive name's still the same. I mean, at one time, Coca-Cola was really a defensive stock. And now, less people with the sugar and all that. Cigarettes used to be defensive because you were addicted to the stuff, but less and less people smoking cigarettes. And so what are some defensive sectors? Let's put it that way.
Well, I think the like you had mentioned already, consumer staples like toiletries, like some of the comfort stocks like Coca-Cola, like things that are, normal day-to-day items that people enjoy. People are still going to spend on themselves in that manner. And I think long-term, that's what people are going to have to get back to.
What about healthcare? The administration, the current occupant in the White House, is making all sorts of extravagant claims, going to bring the price of healthcare down. If he can manage that, that would be the first time in my life and probably your life that ever occurred. Is that a place to be?
Certainly one of the areas to be. Healthcare with the Bidenomics plan, looking into negotiating drug prices with Medicare, I think is an excellent thing. I mean, just the cost of prescription drugs has just gone on way out of control. So definitely, if that can happen, that's certainly a good thing for the health sector.
Hey, when I come back in my next life, I am going to be a prescription drug benefit management company, because they could just pick numbers out of the air, and that's what you pay. You have no possibility unless you go to Canada or Mexico, and that's got problems there too. I mean, I personally purchased drugs, prescription drugs in Canada that were a third the price of what they were in the U.S. In Mexico, I have my reservations about it. We'll just leave it at that. But other countries, like in Western Europe, you can do it. So obviously we're getting shafted here big time, but the taxpayer pays for everything in the end, regardless what they get back.
Very, very true. And while we're on that topic, Kerry, why don't we make a list of all your prescription meds for the month, and then we can go out there and see if we can get that lowered for you.
I'll do it. I'll let them bid on me, like they do for home improvement sites. I'll put it out there and say, if you want my business, how cheap are you going to make it for me? Right?
Right. Exactly.
All right.
So how much do you think the 2024 election cycle is going to play in on the markets and all this crazy stuff that we're going on? I mean, you've been around the block as many years as me.
Maybe a couple more, maybe a couple less, but there's always one big loser in every election in my lifetime, and that's the American people. So we're going to have volatility because, hey, traders love volatility. You want volatile markets if you're a trader. That's how you make money. And and nobody knows what's going on anyway. So volatility rules. And then afterwards, we'll still have volatility, right?
Yeah, it's a never-ending stream, and I guess there's a sucker born every minute.
Two to catch them, don't forget.
Absolutely.
All right. Well, hey, David, really appreciate you coming on, sharing decades of wisdom with us, because you got to put this stuff in perspective. Election cycles, we've both been through an inordinate number, and hopefully we got a bunch more ahead of us. How much really changes after an election? Not very many of them.
That's very, very true. And the Feds have more work to do. They've got quantitative tightening. They stopped that, by the way, during COVID.
Right.
They were reducing their balance sheet with all the money that was lent to the economy, but they stopped doing that. You even if they pause on rate hikes this year and start quantitative tightening, there's more pain that's going to be inflicted on the economy, I think, in the next year. We may not see this drop until next year, but just as sure as you're born, I think it's going to happen at some point.
Yeah, it's got to play itself out. And we didn't even talk about the banking crisis and the fact that it's QE. They're just calling it a different name. It's the Emergency Discount Window Bank Fund to bail out banks.
Right.
And it's all their own fault. But hey, next time we have you on, assuming that not much has changed, probably a couple more banks will have failed by the next time you come on, I would imagine, or be merged, in quotes.
Yeah, which isn't a great thing. You've got 4, and now it's up to 40 regional banks. Every time they rate hike or even leave things the way they are, you're decreasing the net interest margin that these banks can make. They're squeezed, they're pinched with 3% loans on the books, and they got to pay out their customers 4% and 5%. So they're robbing Peter to pay Paul. That's just not going to be good long term for regional banks. And I think that the Feds, before they do anything else, and it remains to be seen what they'll do this month later, I think they're going to have to really, really, really look at the banking situation, because if they're saying the FDIC is going to cover everybody's deposit, I think they're smoking dope on that. I mean, I really believe that they've got to shore up the banking industry, because if people lose faith in that, I think we're all screwed.
Hey, well, fractional reserve banking is all about confidence, and the root word of confidence is con.
Wow. That's true.
So eventually the con game comes to an end, as all Ponzi's must, but they've been pretty good at keeping it running here for 110 years now, David,
Yeah.
110 years. So obviously it's deteriorated over time, but at some point you get to the end of the road where the can can't be kicked down any further. Anyway, hey, tell us again where we find you, best way to connect with you on the internet, David.
Go to Wright Financial Group. That's WRIGHT, financialgroup.com. You can log in there and see all about us, who we are, some of my other appearances, what our philosophies are, what we think is going to happen, because we have this big crystal ball there, but no, not really. But if you come to our website, you'll see a little bit more about us and what makes us tick.
Well, experience many times is better than a crystal ball, or as good, as you know, especially when you have decades of it and you're not tied up in the emotions of the time. Hey, don't forget there's a link in the show notes to this interview right to David's site on financialsurvivalnetwork.com, and just click it while you're there. Sign up for your free newsletter. David, always a pleasure. Thank you so much for joining us.
Thank you, Kerry, for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.